Assalamu alaikum friends, welcome to lecture 22 of SBR. IAS 38 is today's topic, which is intangible assets. Here we are going to go through the definition of intangible assets, recognition criteria, amortization, research and development expenditure, and disclosure. What is intangible asset? We have gone through tangible asset in IAS 16, property, plant and equipment. This is also very similar to asset, okay, especially the recognition criteria and all, and also the measurement. Almost it is similar to tangible asset with few differences. Okay, so intangible means it is unidentifiable, sorry, it is identifiable non-monetary asset without physical substance. The only difference between tangible and intangible asset is tangible you can touch, you can feel, they have a physical substance, you can see them, like your motor vehicles, your cars, your building, your machinery, your land. On the other hand, intangible is you cannot touch. Examples, your goodwill. Goodwill is an intangible asset. Because of goodwill, you are getting returns, right? Computer software is an intangible asset. You cannot touch it. There's no physical substance to it. Patents, copyrights, motion picture films, customer list, marketing rights, mortgage service rights, license, import quotas, franchises, customers and supplier relationships. All these are examples of intangible assets. There are lists. Okay, the most important is the recognition criteria. This is almost very similar to your IAS 16. If you have gone through my lecture IAS 16, recognition criteria is almost same with few addition. When it comes to intangible assets, they are: asset has to be identifiable, asset needs to be controlled by the entity, this is similar to tangible, it needs to generate future economic returns, similar to tangible, cost has to be measured reliably. The last three, second, third and the fourth points are similar to tangible asset, except the first one. The only difference in intangible is one additional point, that is the first point. Asset needs to be identifiable. This point was not there in tangible asset. Why? Because you can see it. There is a physical substance to it. But in intangible, it needs to be an identifiable asset. Okay. An intangible asset is identifiable if it has these things. It needs to be separate. It has to be separable. It has to be capable of being separated and sold. You can transfer it, you can sell it, you can license, you can rent it, you can exchange it, either individually or as a part of a package. If you are able to do it, then it's an intangible asset. If you cannot separate it, if you cannot sold it separately, it's not an intangible asset. Next, it arises from contractual or some legal rights. For example, patent. By law, you are protected if you have a patent. Your product, your design is protected if you have a patent, if you have a copyright. No one can copy your design or the logo that you have if you have a copyright. So these are examples of intangible asset. Why? Because they have a legal right to it. Those intangible assets should have a legal right, right? It doesn't matter whether you can transfer them separately or not, the legal rights. Now, the thing that you need to remember is, what if it's not recognized? If an intangible asset does not meet the recognition criteria, then that expenditure goes to profit and loss account as an expense, and you cannot capitalize it at a later date. It will always remain as an expense. And regarding goodwill, only for goodwill is also an intangible asset, but when it comes to goodwill that arises on business combination, you deal it according to IFRS 3. We have a separate standard which deals with goodwill arising on business combination. That is dealt in IFRS 3, which we are going to cover later. Okay, it is not dealt in IAS 38 like normally how we deal other intangible assets. So this thing you need to keep in mind. Initial recognition, initially you recognize it at cost. This is very similar to tangible asset. Okay, but subsequent recognition, you have a choice, cost or evaluation model. This is also similar to tangible asset. When it comes to cost model, okay, the only difference is there in tangible asset it's a depreciation. When it comes to intangible asset, it is amortization. That is the only difference. Everything is same. So here it will be cost minus your accumulated amortization minus your impairment. And when it comes to revaluation model, fair value minus accumulated amortization minus impairment. Okay. Regarding revaluation, you need to keep in mind for intangible there need to be an active market. Why? Because through active market only you can get the fair value. If there is not an active market, you cannot use fair value for that intangible asset. The reason why this is specifically emphasized in intangible asset is because for intangibles, not all intangibles have active market. It's rare. Some intangibles do not have an active market. So you cannot use a revaluation model. You have to go by the cost model, even though choice is there. Unlike tangible, like car, building, machines, they have a active market. Okay. Active market means where the products are homogeneous, right? Bulk of the similar goods are bought and sold in the market, open market. So you know the price for it. Like cars, like a mobile phone. You know the price. If you go to the market, you will get the price for the similar iPhone that you have. There's an active market for it. Homogeneous means same product. So, but for intangible, this active market is rare. Not all intangibles have. Okay, some have like milk quotas or stock exchange seats. It's easy. Now, some they do not have active market like brand. See, every brand is different. You cannot have an active market for your brand. You will not have a similar brand outside. So brand, newspaper masthead, music, film publishing rights, patents, trademarks, this kind of intangible assets do not have an active market. Okay. And if you have decided to go by revaluation model, it has to be done with sufficient regularity. That means carrying amount of the cost. Okay, carrying amount does not differ materially from the actual fair value at the reporting date. It should not differ so much from the actual fair value when revaluations are done. It should be done with sufficient regularity. It should not be like once you are doing cost, next year you are doing revaluation model. You know, you should be consistent in the model that you have chosen, either cost or revaluation. Stick to one. Regarding gain and losses on remeasurement, it is dealt in similar way for tangibles that was dealt in IAS 16. Like gain and losses on remeasurement to fair value, okay, are accounted in the same way as revaluation gain and losses of tangible assets. How is it dealt? Tell me. The rule is not given here. Tell me the rule. The rule of IAS 16 was gain and losses on remeasurement to fair value goes in other comprehensive income. So same for intangible assets, the gain and losses will go to other comprehensive income. Okay. Now we are coming to amortization. Amortization, you need to remember two things. You have to assess the useful life of the intangible assets, whether it is finite or indefinite. If it's finite, you have to amortize it on a systematic basis. Okay. And remember, amortization starts when the asset is available for use. This is same as depreciation. Same, dicto same. The only difference is this is amortization and there it is depreciation for tangible assets. When it comes to indefinite useful life, you do not amortize it. Indefinite means you do not see a future, unlimited. There's no foreseeable limit to the period. Okay? In the exam, you'll be given whether the asset has a finite or indefinite life. Accordingly, you will deal. If it's finite, you amortize it over the useful life. If it is indefinite, you do not amortize it, but you have to check for impairment. Annual impairment review needs to be done. Coming to research and development expenditure. This is very important because mostly in intangibles, this is done. It's there. Okay. Research expenditure. See, research and development are two separate things. Okay. Don't mix them. Research is a separate thing. Development expenditure is a separate thing. Research is easy. Research expenditures are always expensed. They go to profit and loss as an expense. You cannot capitalize it. Okay. But this is only for intangible. If tangible assets are used in research, they should be recognized as property, plant, and equipment. That is according to IAS 16. Okay. When it comes to development expenditure, you can capitalize it. That means you can recognize it as an intangible asset only if these conditions are there. What are the conditions? Number one, project needs to be technically feasible. The entity needs to complete the intangible asset, then use it or sell it. Intangible asset needs to generate future economic benefits. See, it should not be an intangible asset which is you are developing, you cannot sell it, it is not ready for use, it is not technically feasible. Then you cannot capitalize the development expenditure as intangible asset. Then the development expenditure will go as an expense in the profit and loss account. They are dealt in the same way as research expenditure. Okay. But if these conditions are there, then development expenditures are recognized as intangible asset. In other words, you are capitalizing. Then it needs to have adequate resources to complete the project. The expenditure needs to be reliably measured. 5 conditions needs to be there for you to capitalize development expenditure. If not, then development expenditure is also taken as an expense in profit and loss. Coming to disclosure, this is the last part of this lecture. IAS 38 states that an entity must disclose these things. Number 1, the amount of research and development expenditure that is expensed. Number 2, amortization methods used. Number 3, having indefinite useful life. When you're assessing it, you need reasons to support that assessment. When it comes to indefinite useful life, for definite is no problem because you are amortizing it. But since you are not amortizing, you are saying an asset has an indefinite useful life, you need to come up with reasons why you say so. Date of any revaluations. When the revaluations are done, what are the methods and assumptions used? Because this is a very subjective area. Because active markets are rare in intangible assets, so the standard have become more strict. They are like disclose. A reconciliation of the carrying amount of intangibles at the beginning and at the end of the reporting period. Why do we do this? So that it does not materially differ from the fair value. Okay, so that's it. Now we'll be doing 3 questions before we summarize the whole of IAS 38. Test your understanding 5. Discuss the accounting treatment of the above in the financial statements of Innovate for the year ended 30th September 2003. Okay, so this case study is about a company, okay, which has developed video game called Sports 10 years ago. Okay, they have sold 10 million copies and it's been extremely popular. Okay, the game continues to be bestseller because every year they keep adding. Now directors have produced cash flow projections and based on it they are giving their brand value of 20 million. Okay, their brand is at 20 million based on the projections for the next 5 years, based on the cash flow projections of the next 5 years. They want to recognize this brand of 20 billion in the statement of financial position. Second, on 30th September 2003, they also paid 1 million for the rights to Pets and Me video game series after the original developer went into administration. If you see this question, there are 2 things that you need to deal in this question. One is the 20 million, the other one is the 1 million. Okay. In one, first, before you start this question, you always have to start with the recognition criteria of intangible assets. That is the first. What are the recognition criteria of IAS 38? There are 2 recognition criteria. First one, the probability of expected future economic benefit. The second one, the cost. Okay, economic benefit, cost. These are the 2 things. Okay, so regarding the 20 million, first we'll start with the 20 million. Okay, this, okay, yes, there is a economic benefit to it. Why? Because the cash flow projection suggests so that in the future this brand will lead to future economic benefit. So the first point is satisfied. But what about the cost? See, this brand has been internally generated. You need to know this word. There are 2 types of intangible assets. One that is internally generated, that means that is generated within your company over a period of time. And there is another type of intangible asset that you have acquired from a third party and for which you have to pay. So for internally generated goodwill, intangible assets, you cannot recognize it in the statement of financial position. You don't. But if you have acquired a brand, then you recognize it in the statement of financial position. These are the two things you need to remember. So this one is internally generated over a period of time based on the cash flow projections. They have given their brand 20 million of worth. They have not acquired it from anyone else. So cost, you cannot measure the cost reliably. So it does not satisfy the second point. Therefore, you cannot recognize this 20 million in the statement of financial position. Okay. Coming to the 1 million that you have given to Pet, the Pet and Me brand. This was purchased. This Pet and Me brand was purchased for 1 million. So it satisfies both. The economic benefit is there and also the cost. Therefore, you can measure this in the statement of financial position, the 1 million. Okay. But remember, once you have initially recognized it, okay, at cost, in subsequent period, brand will be, the 1 million brand will be amortized. You have to talk about amortization. Once you have recognized an intangible asset, next is amortization. You need to talk about it always. So brand will be 1 million's worth of brand will be amortized in the subsequent period. You need to mention this in your answer. Over its expected useful life. Okay, you can complete that sentence on your own. The answers are there. Coming to test understanding 6, John. Here also you need to discuss the correct accounting treatment. Okay, so this question is about an intangible asset. Okay, they have included an intangible asset. It is about individual customer, portfolio of individual customers. Okay, this asset is a portfolio of individual customers acquired from a similar business which has gone into liquidation 2 years ago. Okay, finance director has asked, okay, they was asking why the asset is not amortized, why it has not been amortized in the current period. So can I understand the issue here? Why it has not been amortized? Should it be amortized or should it not be? That is your question. You need to solve that. Okay, so in reply, the finance director replied that there's a change in the assessment of the useful life of this asset from finite to indefinite. They justified it by saying that due to number of factors, they cannot foresee the useful life of the asset, such as technological evaluation, changing customer behavior, and all that. Okay, first understand the issue correctly before you come to the answer. Answering is very easy once you understood the issue correctly. The issue is why you are not amortizing it, and whether the change in the useful life from finite to indefinite, is it justified? Can you justify it? If not, then what is the correct treatment? That is the question. So now tell me, if you need to use your IAS 38, you know that, right? There are so many rules in IAS 38. Just now we went through it, right? Research and development, disclosure, recognition, measurement, this, that. From which point do you start? It depends on what is the question hitting on. The question is specifically talking about the useful life. So you need to only talk about useful life. IAS 38. What does IAS 38 talks about useful life? It says that asset has an indefinite useful life only if there is no foreseeable limit to its useful life. Okay, but if you are having any difficulties in accurately determining a useful life, intangibles useful life, it is not a basis. It is not a basis for saying that useful life is indefinite. No, you cannot say that. You're understanding the point? So based on that, now you are linking this to the case study. First, general points. Second paragraph, you are linking this to the case study, John. Okay, this is a customer relationship. This topic is about the intangible asset. Here is customer relationship. What type of intangible asset is this? So this customer relationship, okay, it is, you're dealing with individuals, so it will always have a time limit, right? There is always a limit to the relationship. You will know for how long, for 5 years, 10 years, 20 years. You cannot have an indefinite useful life with a customer forever and ever. It does not go like that. So you are interacting here, you are going against IAS 38 here. You are not following IAS 38 rule here. by changing the useful life from definite to indefinite. You're contravening IAS 38 here because they have a limit. There's a limit to this relationship. That means it should be a definite useful life, not indefinite. And because it is this one, you have to amortize it also. Remember they told why not amortize? You have to amortize. Because definite means once it is this useful life, definite useful life, you have to amortize it. If you do not, then at the end, this is what you need to conclude. You are overstating profit and you're overstating profit and assets in the current period. That's it. Now we'll be moving on to test your understanding 7, the last question. Test your understanding 7. Okay, here you need to discuss the correct accounting treatment for research and development. Okay, during the year ended 31st December 2001. So you have been given during the year 31st December 2001, you have been given some expenses, some breakdown of the expenditure. Okay, they have recognized they have spent 2 million on research and development, and this 2 million was recognized as an intangible asset. They have shown the breakdown: research, marketing research, employment training, development activity. Okay, now coming to development, this activity was incurred evenly over the year. It was not until 1st May 2001 the market research indicated that the product was likely to be profitable. At the reporting date, that is 31st December 2001, the product development was not yet complete. Whenever a question like this comes, okay, first thing, finish off with the research expenditure. All the research thing you finish it off because they are expenses. You cannot they are not tangible, intangible. So here, this one, and this one, they go to P&L as an expense because they are research expenditure. Research, market research, and employee training. Coming to development activities, this you need to break down. This 0.9. See, this 0.9 you can take as an, you can only capitalize it once the product is viable. Once the commercially it needs to be viable. It has to be ready for use. So it is commercially viable after 1st of May 2001. Until 1st of May 2001, it was not viable. That means before 1st of May 2001, whatever the development expenditure you have incurred are expensed as P&L. They go to P&L. That means it started on from 31st December 2001, right? So Jan, Feb, March, April, the first 4 months, they are expensed. So this you have to take the first 4 months only, which is 0.3. Okay. So this 0.3 goes as an expense in the P&L. Out of the balance, okay, 0.9 minus 0.3, 0.6. This 0.6 is taken as intangible asset. They are capitalized. Intangible asset, IA. Okay. And what about amortization of the 0.6? You cannot amortize it. Why? At the reporting day, the product development was not yet complete. When the product is not complete, you cannot charge amortization. It's same as depreciation. When the asset is not ready for use, you cannot depreciate. Same for intangible asset, no amortization. So only you can recognize 0.6 as intangible asset in the statement of financial position. In the statement of financial position. But you have already recognized 2 million as an intangible asset. Now you need to remove. So you see, add all the expenses starting with research 0.5, 0.4, the market research, employee training plus 0.2, out of it 0.3, which is this one. The development expenditure only 0.3. If you add this together, it equals to 1.4. So you need to remove this 1.4 there in the P&L. So out of the 2 million of intangible asset that you have recognized it earlier, you need to take this 1.4 out because they goes in the P&L as an expense. So it is 2 minus 1.4, 0.6. You see, you are ending up with 0.6. So double entry is debit P&L, credit intangible asset, 1.4 1.4. That's it. This is how you need to deal with development and expenditure separately. Okay. Now let us summarize IAS 38. So now let us summarize IAS 38 starting with recognition criteria. Asset needs to be identifiable, needs to be controlled by the entity, needs to generate future economic benefits, and cost needs to be measured reliably. Coming to initial recognition, cost. Subsequent recognition, cost or revaluation. For revaluation, needs to refer to active market. If active market is not there, go by the cost model. For amortization, finite or infinite lives. If finite, amortize, otherwise don't. Research expense goes to P&L as an expense. Okay. Development, if the conditions are satisfied, you can capitalize it. Otherwise, they also go as an expense in the P&L. That's it. Thank you for watching and see you in my next lecture that will be on IAS 40, investment property. Again, it's a very short lecture. Meanwhile, do not forget to subscribe to my channel if you are watching this for the first time. And there is a whole playlist on my YouTube channel for SBR lecture that you can watch from IAS 1 to all the lectures will be there. Thank you and see you in the next lecture.